What if the biggest opportunity of your lifetime doesn't look exciting? It looks quiet. What if the real warning isn't that silver will crash, but that you'll hesitate while the world quietly reprices everything around you? And what if a projection like a $50,000 long-term target isn't about hype at all, but about understanding cycles before they become obvious? Take a breath. This is not about panic, it's about preparation. Years ago, I sat in a small office with a mentor who had lived through multiple market cycles, booms, crashes, recoveries. He told me something that never left my mind. The crowd reacts to price. The disciplined react to cycles. At the time, I didn't fully understand what he meant. I was chasing entries, exits, short-term wins. But over time, I realized something. Wealth isn't built by chasing numbers. It's built by recognizing structural shifts early and positioning calmly. When investors like Dalio talk about long-term monetary cycles, they aren't making emotional predictions. They're studying patterns, debt expansion, currency shifts, supply constraints, human psychology. Whether a specific number ever materializes is less important than the underlying message. Assets tied to tangible value behave very differently when systems are under pressure. Here's the first shift. Stop focusing on the headline number. Start asking why such a number could even be discussed. Big projections are signals that something deeper is moving beneath the surface. When monetary systems stretch, when debt levels expand, when confidence cycles shift, hard assets begin to matter more. But this is where most silver holders make a critical mistake. They hold metal, but think short term. They watch daily fluctuations and forget why they entered in the first place. If your conviction disappears with a 5% move, your strategy was never built on understanding. It was built on emotion. Look at Warren Buffett. Decades of compounding didn't come from reacting to every swing. They came from understanding value deeply enough to hold through volatility. Different asset class, same principle. Conviction rooted in research outlasts noise. So ask yourself, if silver were to enter a multi-year revaluation phase, would you be positioned or distracted? Second shift, separate protection from speculation. If you're holding silver as a foundational hedge, treat it like one. You don't check your home's structural beams every morning wondering if they've appreciated. They exist to support you. When you clearly define a portion of your holdings as long-term protection, stress decreases. That calmness lets you think strategically, not react impulsively. If you choose to allocate a smaller portion for tactical opportunities, that's a different conversation entirely. But never confuse the two. Confusion creates anxiety. Clarity creates confidence. Third shift, build accumulation habits, not excitement. A dramatic prediction like $50,000 can trigger two extreme reactions. Some people rush in recklessly, others freeze, convinced they're already too late. Both responses are emotional. Discipline sits in the middle. Discipline says, what percentage of my income can I consistently convert into tangible value without destabilizing my life? Wealth grows from sustainability, not adrenaline. Think about entrepreneurs like Elon Musk. One principle stands out regardless of your opinion of him. Long-term vision paired with relentless execution. Vision alone is fantasy. Execution without vision is directionless. When you combine a macro perspective on monetary cycles with a practical, repeatable accumulation plan, you create alignment. Fourth shift, prepare psychologically for volatility before it arrives. If silver starts moving aggressively in either direction, your emotions will be tested. Rapid gains create greed. Sharp pullbacks create fear. The investor who wins is the one who rehearses discipline in advance, not in the heat of the moment. Decide now under what conditions you add. Decide now under what conditions you simply hold. Decide now what portion is untouchable. Clarity before chaos is power. Fifth shift. Align your silver strategy with your broader life mission. This isn't about metal. It's about freedom. It's about building optionality. When you hold tangible assets alongside skills, businesses, and cash flow streams, you diversify not just financially, but psychologically. You feel less dependent on any single system, and that confidence changes how you negotiate, how you invest, how you plan. Here's the deeper truth. Projections like $50,000 are not promises. They are stress tests for your belief system. They force you to ask whether you truly understand cycles, or whether you're simply reacting to bold numbers. Instead of asking, will it happen? Ask, am I structurally prepared if major repricing occurs over the next decade? Practical action starts here. Define your target allocation as a percentage of net worth, not as an emotional guess. Build it gradually. Avoid leverage unless you fully understand the risks. Keep investing in knowledge. Read about long-term debt cycles, commodity supply chains, monetary history. The more informed you are, the less shaken you'll be when volatility hits. And remember this, the greatest risk is not that a prediction fails. The greatest risk is drifting through cycles without a plan. You don't need to believe in extreme numbers to act intelligently. You only need to recognize that cycles repeat, systems evolve, and those who prepare calmly tend to stand stronger on the other side. So if you're a silver holder, don't panic, don't fantasize. Build structure, build understanding, build patience. Because whether silver revalues dramatically or moves steadily over time, the real transformation is happening in you. You're becoming someone who studies before acting, someone who positions before reacting, someone who thinks in decades, not days. And that identity is worth more than any projection. When a bold price forecast enters the conversation, most people focus on the number. They debate whether it's realistic, extreme, or impossible. But experienced investors understand the number itself is rarely the main message. Large forecasts are signals. They point to deeper structural conversations about monetary systems, debt cycles, currency strength, supply constraints, and long-term capital flows. If you only react to the headline figure, you miss the real opportunity, understanding what's shifting beneath the surface. Throughout financial history, dramatic projections have surfaced during periods of transition. These transitions aren't random. They're tied to expanding debt levels, shifting interest rate environments, geopolitical adjustments, or technological changes affecting production and demand. When respected macro thinkers analyze these factors, they're not guessing casually. They're studying patterns that have repeated across decades, whether or not a specific target is ever reached. The presence of such a projection invites you to study the cycle itself. Consider Ray Dalio, who built his reputation on analyzing long-term debt cycles and macroeconomic structures. His work emphasizes that economies move in waves: expansion, excess, correction, reset. When you hear an aggressive long-term target tied to hard assets, it often reflects concern or anticipation about where we may be within that broader wave. The disciplined investor doesn't get emotional about the figure. Instead, they ask, what structural conditions would need to exist for such a move to occur? That one question changes your behavior entirely. Instead of rushing to buy or dismissing the idea outright, you begin researching supply dynamics, industrial demand, monetary policy trends, historical price behavior. You move from reaction to investigation. That shift alone separates long-term wealth builders from short-term speculators. Focusing on structure also protects you psychologically. If the market moves slower than expected, you're not disappointed, because your conviction was never tied to a single number. If volatility increases, you're not shocked, because you understood the underlying forces could create turbulence. Big predictions become catalysts for deeper awareness, not triggers for impulsive decisions. When you learn to interpret bold projections as signals about cycles rather than promises about price, you develop patience, clarity, and strategic positioning rooted in understanding, not emotion. Confusion is one of the most expensive emotions in investing. When you don't clearly define why you own something, every price movement feels like a test of your intelligence. If silver rises, you wonder whether to sell and capture gains. If it falls, you question whether you made a mistake. That internal conflict drains energy, because you never decided the role silver plays in your financial structure. Protection and speculation are two completely different intentions. Protection is about stability. It's about holding a tangible asset that exists outside digital balances and complex systems. When silver is part of your protective allocation, its purpose is not daily performance. Its purpose is resilience. You hold it the same way you hold emergency savings or insurance, because it strengthens your foundation. You're not checking it every hour. You're not emotionally tied to short-term appreciation. You're anchored in the belief that it contributes to long-term security. Speculation operates under entirely different rules. When you speculate, you accept volatility as part of the opportunity. You allocate capital knowing that price swings are expected. You define entry points, exit strategies, and risk limits. The mindset is active, not defensive. Problems arise when you blend these two roles. If you secretly expect your protective holdings to behave like a high-growth trade, frustration builds. If you treat speculative positions as untouchable reserves, risk increases. Clarity eliminates this tension. You might decide that a specific percentage of your net worth in silver represents your non-negotiable foundation. That portion is held with patience. It is not moved by temporary excitement or fear. Beyond that, if you choose to take tactical positions, you do so consciously, knowing those positions serve a different objective entirely. This separation reduces emotional pressure because each ounce has a defined purpose. Stress decreases when roles are clear. Decision-making improves when expectations align with strategy. Instead of reacting impulsively to every fluctuation, you observe calmly. You evaluate based on predefined intentions, not feelings. Over time, this structured approach builds confidence. You stop second-guessing yourself because your actions follow a framework. And when your framework is clear, your mind remains steady, even when markets are not. Excitement feels powerful in the moment, but it's one of the weakest foundations for building wealth. When bold projections circulate, when price targets sound dramatic, the natural human response is adrenaline. Some rush in, afraid of missing out. Others freeze, overwhelmed by the intensity. Both reactions are emotional. Neither is strategic. Real progress begins when you replace excitement with disciplined accumulation habits. A habit is quiet. It doesn't depend on mood. It doesn't depend on headlines or dramatic forecasts. It operates on schedule. If you decide that a fixed percentage of your income will consistently be converted into tangible assets, that decision removes the need for constant debate. You're no longer asking whether today feels right. You're executing a plan you defined during a calm moment. Think about Warren Buffett. His reputation wasn't built on reacting to sensational predictions. It was built on steady, repeatable behavior over decades, different asset class, same discipline. The power came from compounding decisions, not chasing headlines. When you internalize that principle, silver becomes part of a system, not a source of emotional spikes. Building disciplined accumulation means setting boundaries. Decide in advance how much is appropriate for your situation. Break larger goals into manageable milestones. Track progress monthly instead of obsessing daily. The structure reduces anxiety because you're not trying to capture every move. You're building exposure over time. This approach also protects you from overextension. When excitement drives decisions, people often allocate more than they can comfortably afford. If volatility follows, stress increases. Stress leads to poor choices. A measured plan prevents that cycle entirely. You participate without destabilizing your broader financial life. Over time, the habit reshapes your identity. You begin to see yourself not as someone reacting to bold targets, but as someone constructing long-term strength. That identity shift spreads into other areas: budgeting, saving, investing in skills, building businesses. Discipline in one financial area reinforces discipline in others. When accumulation becomes routine instead of emotional, you gain consistency. And consistency, repeated year after year, is what transforms modest actions into meaningful financial progress. Volatility is not an accident in markets. It is a feature. Prices move in waves because human emotions move in waves. Optimism expands, fear contracts, confidence builds, doubt returns. If you don't prepare psychologically for these swings before they happen, you will react impulsively when they do. Preparation is not about predicting direction. It's about strengthening your response. When silver moves sharply upward, the first emotion that appears is greed. You begin imagining how high it could go. You calculate hypothetical gains. You feel tempted to allocate more than your plan allows, because momentum feels powerful. Without preparation, that excitement overrides discipline. On the other side, if silver pulls back quickly, fear surfaces. Doubt creeps in. You question your decision. You consider selling simply to relieve discomfort. Both reactions are emotional reflexes. The disciplined investor anticipates these feelings in advance. They decide, under calm conditions, how they'll respond to rapid appreciation, and how they'll respond to temporary decline. This is mental rehearsal. You define your allocation limits. You define what portion is long-term and untouchable. You define whether you'll add incrementally during weakness or simply hold steady. When the plan is clear beforehand, volatility becomes far less threatening because your response is already structured. Consider Ray Dalio's emphasis on understanding cycles rather than predicting exact turning points. Cycles inherently contain turbulence. Accepting that reality reduces the shock. If you expect smooth, linear movement, every correction feels like failure. If you expect fluctuation, corrections feel normal. Psychological preparation also means avoiding overexposure. If your position size fits your financial situation, price swings won't threaten your stability. If you overextend, every move feels amplified. Managing size isn't just a financial decision, it's an emotional safeguard. Clarity, position sizing, and predefined rules form a protective framework around your mindset. When volatility arrives, you observe rather than panic. You follow structure rather than instinct. Emotional control becomes your edge, and in environments where most participants are reacting, calm discipline becomes a powerful advantage. Silver by itself is not the goal. The goal is freedom. The goal is resilience. The goal is building a life where your financial decisions are not controlled by fear or dependency. When you align your silver strategy with a broader mission, it transforms from a simple holding into a tool within a larger blueprint for independence. If your mission is financial stability for your family, silver may represent a tangible reserve that exists outside daily digital systems. If your mission is long-term wealth building, it may serve as one component of diversification, alongside businesses, skills, and cash-flowing assets. If your mission is optionality, the ability to adapt during uncertain periods, then silver becomes part of that flexibility. The clarity of purpose determines how you hold, how you accumulate, and how you think about time. Look at entrepreneurs who built lasting success, like Elon Musk. Their actions were guided by a larger vision. Every decision supported a broader objective. When your financial actions connect to a clear mission, discipline becomes easier, because each step feels meaningful. You're not stacking metal out of habit alone. You're reinforcing a structure that supports your long-term life design. This alignment also protects you from distraction. When markets get noisy or dramatic predictions circulate, you evaluate them through the lens of your mission. Does this change my long-term plan? Does this affect my allocation strategy? If the answer is no, you remain steady. Your direction is defined by purpose, not external excitement. A mission-driven strategy also encourages balance. Silver should not replace skill development, business growth, or personal improvement. It should complement them. True wealth is multidimensional. Tangible assets, intellectual capital, relationships, health, and reputation all interact. When your silver strategy fits naturally within that broader framework, it strengthens rather than dominates your focus. Over time, this integration builds confidence. You see how each disciplined purchase supports your larger vision. You feel less reactive and more intentional. Your financial decisions become extensions of your identity and values, rather than isolated transactions. And when every part of your strategy aligns with your mission, progress feels coherent and directed instead of scattered and uncertain.